Hey, good afternoon, options traders, and happy Friday to everyone. Another good question for the group. What is the EV triangle? Now, don't go looking this up. This isn't really an official name for it. There isn't really an official name, but the concept is well known among all professional traders, and that's what's most important. So let's go dig a little deeper. What is the EV triangle, and why is it so important to understand? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So the EV triangle stands for the expected value triangle. The expected value is just a mathematical calculation that says if we were allowed to take this trade or a particular bet over and over and over, what should you expect in the long run? Should you expect to make money, take a loss, or just break even? And the expected value will show you that. So within this triangle, we have a win rate, we have a win amount, how many dollars are you looking to win, and then we have the expected value. Now I've highlighted the expected value in red as we're going to find out this isn't really a choice, it's a belief that a lot of traders make. But the thing that I wanted to point out is that these three pieces, win rate, win amount, and expected value, make up the EV triangle. And here's the most important point, that you only get one choice out of these three. And you're going to find a lot of traders think, oh, I want it all. You can't. And there's a reason. So the three pieces, again, are the win rate. Do I want to win 20% of the time, 50, 80%? That's what we mean by the win rate. Down here we have the win amount. This is the amount of dollars. And then over here we have the expected value. Now again, the expected value is in red because you can't just command that. You can't say I want a trade that always has an expected long-term drift and always wins. But a lot of people think that's what they have. So it is a possible choice, or maybe a target would be a better word, for the reason for taking a trade. So the expected value is a formula. We've actually seen this before. And here's the way you're going to calculate it. You're going to take the probability of the win. Maybe there's a 60% chance that you win. We're going to multiply that by the amount of dollars that you win. And then we're going to add that to 1 minus p. This is simply just, it's called the complement, but if this is a 60% chance, 1 minus 0.60 would be 0.4. And that should be obvious. These have to add up to 1. If there's a 60% chance to win, there's a 40% chance to lose. If it's an 80% chance to win, it's a 20% chance to lose. So this green p and the red 1 minus p are tied together. You can choose one, but you can't choose both. Now, normally people don't look at it as the probability of the loss, so we don't really put that in the triangle, but people usually choose a percentage of a win rate. But at any rate, we take this probability of a loss times the amount of dollars you would lose, and when we add these things up, we get the expected value. So let's look at an example. We've seen this one actually many times for a coin flip. Let's say we have the offer to flip a coin to win $1. Now, if we do that, the market is going to set the expected value to 0. At least that's the expectation. Why? Because nobody's going to take the other side of the bet knowing that you're going to win most of the time. So the basic idea of the triangle is that there's no free lunch. So for our coin flip game, we might see this. We have a 50% chance to win $1. We have a 50% chance to lose $1. And if we multiply these out and add them up, we get 0. So our expected value is 0. So once you realize that nobody's going to intentionally take the wrong side of the bet, you can see how these are all linking up. If you want a 50% chance to win, you absolutely have to have a 50% chance to lose. You don't get this choice. If you want it to be a 50% chance for $1, you can certainly specify the amount you want to win, but then the math is going to say there has to be a 50% chance to lose $1. This gets forced, and it all gets constrained because the expected value has to be 0. So what this means is that if you were to take this bet here over and over and over, you should expect to just go sideways. And here, look at this, 10,000 flips. So sure, you can have streaks where you're actually up quite a bit, areas of some losses where you're down, but overall, you're just going to go sideways. That's very indicative of a fairly valued bet. There's no long-term upward drift or downward. So we can see that this just means there's no real reason to take this type of a trade. So what if you want a high win rate? Well, traders who do this, they say, I'm looking for a strategy that has a high win rate. Well, that sounds good on paper. So you're saying, of course, you want a greater probability of winning. Who doesn't? And this is very common with like naked puts. We're going to sell far out of the money naked puts because I've heard that they win 80% of the time. Well, that might be true, but let's look at how the math plays out. We have to respect the expected value triangle. So let's say that somebody tells you that this strategy wins 80% of the time, and you can win, let's say, $1. If that's true, this is a part that traders miss, we have to understand that the market is going to force the expected value to zero, at least theoretically. And that means 20% of the time, you've got this very big loss waiting in the wings. And this is the part they don't tell you about these strategies. Traders hear, oh, I heard about one that wins 80% of the time. And they never stop to think that that does not mean that you have a positive expected value, because the markets don't offer a free lunch. And the only way that could be true is that there must be a 20% chance to lose 4. So yes, you might be one of these traders who is doing something like this, selling these far out of the money naked puts, and you might have done it 8 or 10 times and not had any losses. But that doesn't mean you found the Holy Grail and that there are no losses waiting in the wings. There are. Why? Because of the EV triangle. We know that there has to be large losses, even if they're a relatively low percentage of the time. It has to be, again, based on this premise that the market is not going to offer a free lunch. And then finally, what if you want a high payoff? This is just saying that you want big rewards. All right, so maybe you found a strategy where you can win $50. Well, you can specify that, but you can't specify the probability. Remember, you get one choice. And as soon as you say, wow, look, this thing could win $50, the market automatically assigns an 80% chance to lose 12.5. Yes, I've got this monster dollar payoff, and there's some associated probability, whatever it may be. But the market is going to assign this. Again, you can only pick one. Why? Same answer. The market is going to force the expected value to zero because there are no free lunches. Now, what if, on the other hand, you said, I want a strategy that has a positive expected value? And again, this is kind of a gray area. You can certainly try to find those, but again, the markets aren't going to be too lenient about that. They can occur, but they won't be long-lived because people will jump on it. They will arbitrage that out. The very presence of a positive expected value is going to be the cause of its death. So still, you might hear traders say, well, I heard that this strategy has a positive expected value, or I've been doing this for a long time and it has a positive expected value. Again, thinking that they found the Holy Grail. Well, if you think that you are going to choose a positive EV, remember this is one of the corners of the triangle, it means a combination of things. You're either expecting a greater probability of winning, or expecting a greater payoff than fair value, or expecting to lose less than fair value, or all of the above, or some combination. Now you can get multiple picks, but this is why it's a gray area. You have to be very skeptical if somebody says they found a strategy with a positive EV. So for instance, we might say that 60% of the time you win this coin flip for $1, 40% of the time you lose $1, and now you have this positive $1.40 expected value. Yes, if you could find that, that would be phenomenal. But the point is that if you do, others are going to find it too. And as they start competing for it, the price is going to get bumped up. And once it hits $1.50, there goes your EV back to zero. So once again, even if it is true that we have found a positive EV trade, it's not going to live very long. But just for the sake of the argument, if you did find it, this is what it would look like over time. You now have a definite upward bias. So why does the market do this? Well, it does it again just because nobody will intentionally take the bad side of the bet, especially over time. And even if they do, they're not going to survive very long. So think of it like with Vegas, with the game of roulette. There's lots of different bets you can take, but once we look at the details, this is what we see. If you want the single number bet, right, you can choose that and say, I want to have a $35 payoff. That's one of the corners of the triangle. But then this gets set. There's a 1 in 38 chance. Nothing you can do about that. And then this gets set. There's a 37 and 38, remember 1 minus P, that you're going to lose $1. Nothing you can do about that. So yes, you have the right to choose that you want this high payout, but then in this case, Vegas sets the price, and that's what's giving it this negative edge. But the point to see is that you cannot say, I want to get the $35 payoff, but I want to do it for these odds. So again, that's just showing you don't get two choices. If you want roughly a 50-50 shot of winning, sure, you can play down here, but now you've got an 18 out of 38 chance of winning $1. That gets set, and the 20 out of 38 ways of losing $1, that gets set, and the EV gets set. It all has to add up based on the simple principle that the market does not give you freebies, does not give you a free lunch. And if you understand that everything gets forced at least to an expected EV of 0, now you see why you only get one choice. So this is why you have to be super careful if you hear about, again, a naked put, far out of the money naked puts. Well, I heard it wins 80% of the time. Don't stop there. Ask yourself, why does it win 80% of the time? Because there's a 20% chance that it loses, and those losses are going to be 4 times bigger than the wins. That's what you have to be prepared to battle. So the idea of this EV triangle is pretty simple, that you only choose one corner, and the market chooses the other two. The market lets you pick a preference, but not an outcome. And we saw that with the roulette board. So here's another kicker to think about. If you think you chose all three, then you have definitely missed the risk. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new podcast called Thinking Options. This is through Market Rebellion, and it will be on YouTube. I'll throw some links in the description below, but you can also find it on Apple Tunes and Google, Spotify, a number of the podcast outlets. So please support that. It would be greatly appreciated, but it's going to be a lot of information. You will definitely love it. And then finally, please join us on Options A to Z's Facebook trading group. And as before, you can find a link in the description below.